Time is money. Start young, retire wealthy. You're young. You're making money. Retirement. That's ages away, right? Wrong. Time is your biggest asset when it comes to retirement. The earlier you start, the better. Think of it like this. You and your friend both want $1 million by retirement. You start investing in your 20s, your friend in their 40s. You contribute less each month but still hit the $1 million mark because of one thing: time. This is the magic of compound interest. Your money makes money, and then that money makes money. It's like a snowball rolling downhill, getting bigger and bigger. Starting early lets you harness this power. Even small amounts add up over time. So don't wait. Start investing today, even if it's just a little bit. Imagine this. You invest $100 today. It earns a 10% return, so you now have $110. Next year, you earn another 10%, but this time, it's on $110, not 100. You see how this works? This is compound interest in action. Your money grows exponentially, not linearly. The longer you let it compound, the more dramatic the results. This is why starting early is crucial. Even small, consistent investments can grow into a substantial nest egg over time. It's not about being rich now, it's about being consistent. Use a compound interest calculator online to see the magic for yourself. Plug in different scenarios, starting amounts, interest rates, time periods. You'll be amazed at the difference a few years can make. Risk and reward. Finding your investment sweet spot. Investing always involves some risk, but it's about managing that risk, not avoiding it altogether. Your risk tolerance, how comfortable you are with market ups and downs, depends on your goals, timeline, and personality. High-risk investments like stocks have the potential for high returns, but also come with the possibility of losing money. Low-risk investments like bonds offer slower, steadier growth with less volatility. The key is to find the right balance for you. This is called asset allocation, dividing your investments across different asset classes, stocks, bonds, real estate, etc., to manage risk and maximize returns. A diversified portfolio helps cushion your investments against market fluctuations. When one asset class is down, another might be up, balancing out your overall returns. Stocks. Riding the market roller coaster. Stocks represent ownership in publicly traded companies. When you buy stock, you're essentially buying a small piece of that company, making you a part owner. This ownership entitles you to a share of the company's profits, which can come in the form of dividends or an increase in the stock's price. When you buy stock, you're buying a small piece of that company. This means you have a stake in its success, and conversely, its failures. The value of your investment can rise and fall based on the company's performance and broader market conditions. Stocks can be volatile in the short term, but have historically provided higher returns than other asset classes over the long run. This volatility can be influenced by various factors, including economic indicators, market sentiment, and geopolitical events. Despite the ups and downs, many investors see stocks as a key component of a diversified investment portfolio. There are different types of stocks, each with its own risk and reward profile. Common stocks give shareholders voting rights, but no guarantee of dividend payments. Preferred stocks, on the other hand, provide no voting rights but typically offer fixed dividend payments. Large cap stocks are shares of large, well-established companies, often with a market capitalization of $10 billion or more. These companies are usually leaders in their industries and are considered more stable investments. Small cap stocks represent smaller, potentially faster-growing companies with a market capitalization between $300 million and $2 billion. While they offer higher growth potential, they also come with greater risk. You can invest in individual stocks or through mutual funds and ETFs that track specific stock market indexes, like the S&P 500. Mutual funds pool money from many investors to buy a diversified portfolio of stocks, while ETFs are traded on stock exchanges and can be bought and sold like individual stocks. Investing in individual stocks requires research and careful selection. This means analyzing a company's financial statements, understanding its business model, and keeping an eye on industry trends. It's a time-consuming process, but can be rewarding if done correctly. Remember, stock market investments are inherently risky, and there are no guarantees. The market can be unpredictable, and even the most well-researched investments can lose value. It's crucial to be aware of these risks and to have a strategy in place to manage them. It's essential to do your research, understand the risks involved, and invest only what you can afford to lose. Diversifying your investments can help mitigate some of these risks. This means spreading your money across different types of stocks, industries, and even other asset classes like bonds or real estate. By doing so, you can reduce the impact of a poor-performing investment on your overall portfolio. Bonds, the steady eddy of investments. Bonds are essentially like loans that you give to governments or corporations. When you buy a bond, you're essentially lending money for a fixed period at a fixed interest rate. Now, bonds are generally considered less risky than stocks and provide a steady stream of income. Government bonds are considered the safest, while corporate bonds carry a slightly higher risk but may offer higher returns. It's interesting to note that bond prices and interest rates move in opposite directions. So, when interest rates rise, bond prices fall, and vice versa. Bonds can provide stability and diversification to your investment portfolio, especially as you get closer to retirement. However, it's essential to remember that even bonds carry some risk, and their returns may not keep pace with inflation, especially in a low interest rate environment. Real estate has long been a popular investment option, offering the potential for both income and appreciation. You can invest in real estate directly by purchasing property or indirectly through REITs or real estate investment trusts. Owning rental properties can generate passive income and provide tax advantages, but also requires significant upfront investment and ongoing management. REITs offer a more liquid and accessible way to invest in real estate, allowing you to buy shares of companies that own and operate income-producing properties. Real estate investments can be illiquid and require a long-term investment horizon. It's crucial to carefully consider the risks and rewards before investing in real estate. Mutual funds and ETFs, or exchange-traded funds, are investment vehicles that pool money from multiple investors to invest in a diversified portfolio of assets, such as stocks, bonds, or other securities. They offer a convenient and cost-effective way to achieve diversification without having to buy individual securities. Mutual funds are professionally managed, while ETFs typically track a specific market index. When choosing mutual funds or ETFs, consider factors such as expense ratios, historical performance, and investment objectives. Investing in mutual funds and ETFs is an excellent way to simplify your investment strategy, reduce risk, and potentially enhance returns. Even with the best intentions, young earners often make mistakes that can sabotage their retirement savings. Here are some common pitfalls to avoid. Procrastination. Starting late is the biggest mistake. The sooner you begin, the more time your money has to grow. Not saving enough. Aim to save at least 15% of your pre-tax income for retirement. Ignoring fees. High fees can eat into your returns over time. Choose low-cost investment options. Chasing returns. Don't jump from one hot investment to another. Stick to a well-defined investment plan. Not adjusting for inflation. Your retirement savings need to outpace inflation to maintain their purchasing power. By avoiding these common mistakes, you can stay on track to reach your retirement goals. Remember, it's a marathon, not a sprint. The most important thing in retirement planning is consistency. Don't get discouraged by market fluctuations or life's unexpected events. Stick to your investment plan, make regular contributions, and let compound interest work its magic. Review your portfolio periodically and make adjustments as needed based on your goals and risk tolerance. Remember, time is your greatest ally. The earlier you start and the more consistent you are, the better your chances of achieving financial freedom in retirement. Start small, stay consistent, and enjoy the journey. Your future self will thank you.